Good afternoon, ladies and gentlemen, and welcome to the CENTRALNIC Group PLC full-year results 2021 investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time using the Q&A tab that's on the right-hand corner of your screen. Just simply type in your question at any time and press send. The company may not be in a position to answer every question it receives during today's meeting. However, the company review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we would like to submit the following poll, and if you would give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand over to Ben Crawford, CEO from CENTRALNIC. Good afternoon.
Thanks very much, Mark, and hi everybody. Thank you for attending today. Today we'll be reviewing our results for 2021 and also talking about our new acquisition, a company called VGL. So just as a reminder of what we actually do, CENTRALNIC provides the tools to help businesses succeed online, and we group those into two divisions. Firstly, the online presence division, and that sells the basic tools to get online: web addresses, websites, hosting, email, and all of these are annual subscription products. So our business receives from each customer annual payments to retain the services they've bought over the years. And you can see that part of the business has grown at 9%. So which is very good for that kind of business. It's double the types of growth rates that we've experienced in years gone by. So very happy about that. Second half of our business is called online marketing, and that's where, for people that already have websites, we provide them with the tools to either acquire more customers to their websites if they're an e-commerce company, or if they have a high traffic website like a media business or a blog and so on, we help them make money from that traffic. They're also recurring revenue businesses, but they work in a different way. The customers have long-term contracts, and they tend to just put business through us continuously. So, for instance, if they're a retailer, they want a constant stream of customers from us, of people that will buy. Similarly, if they're a publisher, they want a constant stream of revenues for their traffic. And you can see that this part of the business has grown at a pretty phenomenal 65% organic growth year on year. The orange parts on the top of the bars represent adjustments for acquisitions that we made during the course of the year, and hence because we wanted to be very clear, we're doing an exact like-for-like comparison to measure the organic growth of these businesses. Now, why does the business grow so fast? Firstly, the online marketing segment is just a much faster growing part of the internet, and I guess each customer pays us much more frequently. So whilst for websites, customers only pay us once a year, here our clients pay us every single time they win a new customer, and obviously they're trying very hard to make that happen as frequently as possible. So just high-level highlights of what we did last year. We continued our investment into staff and systems. We've built our company through acquisitions, but over the past couple of years, we've been creating a much larger head office function with centralized HR, full finance suite, including treasury, sales tax, corporate tax experts, and so on, as well as technical support, project management, product, and so on, all centralized to free up the managers to really focus on that organic growth. And the results have clearly paid off. $10 million of investment, followed by $116 million of year-on-year organic growth. Now, we're very different from those tech companies that have really benefited from COVID. Honestly, we didn't really. We got a small bump, but where we've really seen our growth is as COVID has had less and less of an impact over the last year. Our business has accelerated faster and faster, and so clearly that's not related to COVID. It's related to, one, the growth of the internet, the advertising market per se, and secondly, to the growth of our business. resulting partially from the investment, and then there is some market factors that do help us, and that is the new internet privacy measures that support our growth. So these are things like, one, just general consumer sentiment that they don't like tech companies taking their data and selling it. Secondly, regulation, things like GDPR. And lastly, the policy changes of companies like Apple and Google and so on to prevent people's data being spied on, being stored, and being sold. And why do these help our business? Because we never, ever used any of those types of tools. None of our online marketing tools collect private data at all. And so hence, as customer sentiment has moved and regulation has moved towards privacy safe online marketing, obviously we've fallen into favor. Now I'm going to hand over to Michael to take you through the financial results for 2021.
Thank you, Ben. So 2021 was the best year in the financial history of CENTRALNIC, as every year as so far. Revenue increased by 71% to $410 million, and net revenue and adjusted EBITDA increased by almost 60% to $118 and $46 million respectively. Also, the adjusted EPS is up by almost 20% to near 12 US cents. And on operating profit, we went from a small loss position in 2020 to more than $1 million of profit every month. Last but not least, the adjusted cash flow also increased nearly as strong as the adjusted EBITDA by more than 50% to now notably more than $50 million in the year just ended. As you could already tell from the figures on the prior slide, when we go into the more detailed P&L, you will see that the net revenue or gross profit has increased slightly less than the revenue, which means that the gross margin, the blended gross margin of the group has diminished from 31% to 29%. However, this is a pure product mix change. The online marketing segment has a structurally lower gross margin than the online presence segment. And given the strong growth of 65% organically compared to 9% for the online presence segment, just more of our business is today online marketing, which automatically makes that the blended gross margin is smaller, even though the margins in the businesses are largely stable. When we then look at how adjusted EBITDA translates into operating profits, we see that the adjusted EBITDA increased by $17 million rounded, whereas the operating profit increased by only, in quotation marks, $14 million from last year, or from 2020 to the last year. We see that the discrepancy lies entirely in one item, amortization of intangible assets, where we need to recognize after each acquisition a certain part of the purchase price for these assets, like customer relationships, etc. However, other than physical goods, you never buy new ones. You don't have to buy your customer relationships yet another time. You don't have to buy your trademark yet another time. So this item is all non-cash in this period and also in the future periods. The money has already been spent a long time ago. And this is also why all equity analysts who cover our share unanimously strip this item out when analyzing our profitability. Moving on to the balance sheet, probably the most notable items lie at the bottom of the slide. So the gross cash amounts have almost doubled. So the company is in a very good liquidity situation currently. But also the net debt has diminished by $10 million, and that's despite us having invested $18 million in 4 highly accretive transactions during the year 2021, plus a few earn-out payments for prior year acquisitions, together roughly $20 million. So having said that, you can also tell just from the statistics that the cash conversion of the business is very strong. The question is, where does this come from? Here on page 9, you see the cash flow statement under IFRS. No adjustments here, but also on this full GAAP presentation, cash flow operation has increased by 80% from around $23 to around $41 million. But given that also our cash flow is also impacted by the M&A activity, IFRS doesn't distinguish between illegal bill for a due diligence or for a customer complaint. We have started 2 years ago to systematically provide this bridge, and as you can tell from the chart, our cash conversion has been always very high, 113% in 2019, 120 in 2020, and now 116 in 2021. So all within a very narrow corridor, and this is very important to us because it demonstrates that neither us venturing from online presence into online marketing has diminished our cash conversion ratio, nor the now dramatically accelerated organic growth. And the reason for that is that on both sides of the business, it is a market convention that most of the transactions are prepaid. And when you think about it for online marketing, it is quite common sense. Because if you are an e-commerce company that ships a good and the customer doesn't pay, you could come and collect it. However, once you've delivered ad impressions, you can never go and take them back. And for that reason, given that prepayment is the standard settlement method, it makes that in the end, while both services are different in nature, economically, they are quite comparable. Then a few words on some P&L items where we receive frequent questions. Operating expenditure increased by $26.5 million. However, the majority, almost 2/3 of that, is acquired operation expenditure from all the acquisitions that were not part of the group for all of 2020 or have only been acquired in 2021. The other 25 to 30% of it is that investment in operational cost, HR, IT systems, etc. That are in here, but which have then also triggered the substantially accelerated growth rates. Amortization of intangible assets we have addressed when discussing the bridge from adjusted EBITDA to operating profit. The non-core operating expenses, this is all the expenses for us to curate our portfolio of companies, starting with identifying great new acquisition targets, negotiating the deals, doing the due diligence, refinancing the transaction, and restructuring and integrating the business to become part of the CENTRALNIC ecosystem. And as you can tell, expressed as a percentage of our adjusted EBITDA, the number has already come down quite notably from 2020 to 2021, a persistent trend that we've seen over all the past years. But also in 2021, there is a roughly $1.5 million component in there of that we called other. Other stands for a strategic review, and we didn't want to use that term, given that a strategic review is a London City code word for a sales process, in particular a fire sales process of a company, and nothing could be further from the truth. Here it was a proper strategic review where we agreed with the board of directors to have an independent assessment of the quality of the two businesses after we had pivoted from standing on one leg, online presence, to now having grown a second leg of online marketing. The result of that is that both businesses are great businesses to be in, and this is why the board has agreed with us strengthening both businesses through M&A, Safe Brands and Name Action, reinforcing the online presence business, Wando and White & Case, augmenting the online marketing business. But it also means that there is a notable one-off component in here that is not a direct part of our continued M&A strategy, and therefore we are hopeful that we can that in a year's time we can present even a diminished number, which then expressed as a percentage of hopefully even higher profits, will come down to low double digit, or with a bit of luck even the single digit percentage area. Last point before I hand back over to Ben, finance cost. The finance costs are mostly driven by a bond, out of which we have already issued 3 tranches, and now for the acquisition of VGL are issuing a 4th tranche. The bond holds a 7% coupon. However, on the last 2 raises in February 2021 and now on the current raise for the VGL transaction, we've been able to obtain a premium on the bonds, which neutralizes the coupons or mitigates it, I should say, and which gives us a very good indication that the current bond investors are looking for a yield of around 4.5%. So our credit risk has dramatically improved over the last 2.5 years, and this makes us very hopeful that once we go into a refinancing exercise, which could already be as early as this July, that we could reduce the interest rate by 2% or more, which would then, all other things being equal, translate into an annualized $2.5 million of interest savings, which then translates into almost $1 of EPS. So this refinancing exercise would have a potential to create to incur a high single-digit EPS accretion all in itself. With that, I hand back over to Ben for strategic priorities.
Thanks very much, Michael. So our current and future strategic priorities are firstly, organic growth in all its forms, winning new customers, growing our existing customers, cross-selling new products, new suppliers. Secondly, operating leverage. We believe this will become more and more visible in the medium term, somewhat influenced by integration savings, but in the current labour market, we doubt very much we'll be laying off any staff, as getting good staff is actually one of our biggest challenges as we continue to grow. But much more importantly, as we operate platform businesses, the margins improve with scale, and we've seen this with our peers on NASDAQ that operate similar kinds of platforms to us, but have much larger scale, and their margins are likewise higher than ours. M&A remains a focus, and we're always looking for targets that match our own recurring revenue, high cash conversion profile, and we are also, I'd say, very good at M&A, and particularly at finding great value. And so we continue always to be focused on that. And then when it comes to debt, our current interest rate on our bond is 7%. We'll be able to refinance that in July, get the interest rate down below 5%. Our net debt to EBITDA ratio is currently 1.6. If we just continue trading as we are, we'll get it down below 1 before the end of the year, assuming we don't use cash for other acquisitions, for instance. And our interest rate coverage is 4.5 times, and we're not expecting that to change moving forward. ESG remains a priority for the company. We have an extremely diverse workforce. Inclusivity is really at the heart of what we do. Our slogan is making the internet everybody's domain. And that means not that we're collecting private data on people all over the world and selling it, nor does it mean we're trying to sell, American culture to people in every country in the world. What we actually sell is the tools for people to build their own websites and build their own businesses online, and hopefully internationalize the internet as they go. Carbon reduction has been a focus since 2012 when we first announced that we were carbon neutral. However, we had to step back from that statement as we acquired businesses that weren't carbon neutral, but now through a combination of improved efficiency and offsets, we're back in the carbon neutral territory. And lastly, we do have a grant program where we've donated over 500,000 euros in grants for education projects, cybersecurity projects, and accessibility projects for technology and the disabled. Very good. So now let's move to VGL, the company that we're in the process of acquiring. VGL is Germany's leading product comparison site. So if you want a UK equivalent, think about Which or Future. So they have a content team of editors and web developers that commission a large group of freelance writers to create content that's extremely templated and based on a model that they have developed and found to be extremely effective. So people come to look at that content. It provides a range of different products all in the same category and allows you to compare and select the one that you're interested in buying. Then when you select that one, it refers you to an e-commerce shop where you can actually buy it. They have relationships with a number of the best known and leading e-commerce brands in the world. And when they refer customers and those customers actually buy a product, they receive a commission. And we're talking about tens of millions of products a year here. When it comes to the traffic on their websites, a large proportion of it actually is walk-up traffic. So these are people that already know the names of the websites and type them in or click on a link, but it costs the company nothing. And so when they receive a commission, it's 100% gross margin. And that is topped up by their media buying team, who are experts at advertising on the internet and driving more traffic to their websites, which then also convert to revenues. So all up, their actual EBITDA for last year was $11 million on revenues of $55 million. This is a snapshot of the kind of website that they produce. They're constantly updated. They're a German domestic provider, so they're in German. And you can see there's two types of content there. There's photographs with very clear labels that say things like best quality, best value for money, most popular, on sale now. So those are for people that like to make a fast decision about what they want to buy. And then down the bottom, there are a series of links to much more detailed information, product reviews, features lists, ratings, videos for things like assembly and so on. So for those people that want to do some deep research before they decide which product they want, all of the information is there. But the result is the same. It's on this site that customers decide which is the product for them, and then they click through and they acquire it. As I mentioned, they're significant advertisers, as well as having great products that rank high, or great websites that rank highly in Google, and that does enable them to take up a lot of the Google search results pages. They are expert advertisers, and you can see that's an ad of theirs up the top, and then they have multiple different websites that cover the same category, so they can appear at various different points in the first page of the Google search results. Some of these are actually in a partnership with the largest publisher, Axel Springer, in Germany. And so they're a big magazine publisher. Around each magazine, there are communities of people that are interested in those subject matters. And so they connect up with VGL to offer the products that relate to that interest group. So together, this partnership of Axel Springer and VGL is very similar to the business model of Future here in the UK. So summary of why we're doing the deal. Well, we get the traffic, and we actually have multiple partners that we can sell traffic to today. And so obviously that's something where they're selling it to their current partners, but potentially we could get more money for it in other areas. We have the great content and the content creation team, which we don't really have at this point. So it's really adding a new string to our bow. They have e-commerce partners that they have large-scale relationships with. We don't have that at the moment. So we have different kinds of monetization partners, but not e-commerce companies. So that's fantastic new relationships they bring into the group. And the deal is immediately not only earnings accretive at double digits, but also margin enhancing. And this company, VGL, has higher EBITDA margins than we do, and we believe we can improve them. When it comes to growth opportunities, this is a company focused on the German language market, but because of the EU, there are other countries, neighboring countries, that have essentially the same products, same product numbers, same standards and specifications. So there's absolutely an opportunity to extend their footprint into other geographic and language areas through the EU. And we could do this much cheaper than a company just trying from scratch to do that. We've already identified opportunities where there are rebate programs from the big e-commerce companies. The online marketing can be achieved comparably. And we already have critical presence, which obviously creates a good bed to launch new products in. Now they can also, though, expand in Germany. They cover 10 large categories like kitchen gadgets, home improvement, sport and leisure, but they don't cover every single product that they could yet. So there's definitely room for expansion in Germany. And then this is a rather small thing, but as we continue to develop new websites, no company has better access to names for websites, domain names, than we do. We have direct relationships with all the wholesalers in the world, as well as access to the domain names that are dropped or deleted when companies decide they don't want to use them anymore. So that, together with the new content we're getting, means we'll be able to put together a fantastic new websites at scale. On the cost side, whilst they have a fantastic and very professional and large-scale media buying operation, we actually have another one that buys ads in different places. So they're specialists in buying ads from search. We are from social media and native. And so that, and we believe that we could buy traffic cheaper than they can in some instances, which would reduce their costs, improve their margins. Secondly, we have a second company in Berlin, Wando, that we acquired around a year ago. We're planning to shut their offices and move their staff into the billboard offices. And then lastly, because of our large scale compared to VGL, we're able to move them onto our pricing schedules with suppliers, and therefore again reduce their costs. Now, Michael, do you want to take us through the numbers around this deal?
Yes, happy to. Thank you, Ben. And what we've done here is a simulation how CENTRALNIC would have presented its 2001 financial year if Billboard and also all the other acquisitions undertaken in 2021 would have been part of the group for the entire financial year. And the answer is our revenue would have been $470 million and the EBITDA $58 million, also applying a 1% uptick in our blended EBITDA margin. And we expect this transaction to be highly accretive. As you can tell from the bottom left corner, the consideration that we agreed with the sellers represents 6.2 times EBITDA, trading EBITDA, I should say, which is notably below the implied multiples at which CENTRALNIC is currently trading. And on the right hand side, you see a simulation in order to diminish the dilution and optimize the value creation for the shareholders. We are putting in a 21 million euro debt tranche, which will, however, still make that our leverage ratio comes down from 1.6 times if we had not done the transaction to 1.5 times having done the transaction. And from here, the company would then organically delever quickly below 1 times, probably still before the end of this year. On the next page, we have the transaction terms. So again, enterprise value 60 million euros, including customary adjustments for net cash and working capital 67 million euros. There is an earn-out component. However, the effective multiple can only come down through the earn-out, that under all circumstances, the EBITDA would always increase faster than the purchase price is being topped up, which would then further enhance the earnings accretion. And the financing has been undertaken through a 42 million sterling fundraise, which we announced has already been closed, well oversubscribed, and we're still having this open offer so that other holders who could not be brought into that vehicle can still pick up their shares. Admission and settlement of the new shares is the 2nd of March. and the difference to the purchase price is being funded through a commitment facility with Macquarie, who pay us even a premium on top of nominal value, given that we could already call the bond in 4 months and a week. This then translates into a yield expectation of roughly 4.6%, as pointed out when we were discussing the slide on our net debt. This takes us to the end of our presentation, and we are now open for questions.
That's great. Ben, Michael, thank you very much indeed for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand side of your screen. But just while Ben and Michael take a few moments to review those questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard, and we will notify you when they're ready for your review. Ben, Michael, as you can see, there's a number of questions submitted by investors today. If I may, could I hand back to you to read out those questions and give a response where it's appropriate to do so? And I'll pick up from you at the end.
Very good. Thank you, Mark. Yes. So first question is, as I believe you recognize your services you offer are very sticky, much effort being needed to switch hosting providers. Do you agree? And what steps might you take to capture customers hosted elsewhere? Excellent question. So absolutely. So the statistics are this, that less than 2% of customers switch providers in this industry in any 1 year. So incredibly sticky. And you're right, it does provide a challenge, but it also provides a great opportunity, and that opportunity is acquisitions. So in our industry, you can acquire a company without being concerned that you're going to lose the customers. So even if the head of sales or the CEO or the head of customer service leaves your company, unlike other companies, they cannot take their customers with them. And so it makes it a really attractive industry to do a roll-up strategy in. Then when it comes to the challenges, it's true. It's very challenging to win new customers or win old customers away from competitors. It puts the focus on winning new customers who are just starting out, building a website and so on, because they're still up for grabs. Where we do actually get some benefits, though, is where companies are merging, and we can potentially go to those companies and say, hey, we can offer you a integration as a service where they do have a ongoing dependency on us. So that's one way we've been able to capture customers hosted elsewhere. And another, which we're working on, is a far more automated way of doing it, making it much easier, taking away the risks, the costs, and the hassles of doing it. But it's, it remains a challenge, and that is really why our industry lends itself far more to a roll-up strategy than simply an organic growth strategy. Next question. Great numbers. What were the reasons behind the strong performance of the online marketing division? So I think we've somewhat answered that question. So we absolutely won new customers, and those new customers and existing customers grew very rapidly. We obviously had some that grew faster than others and are much bigger than others, but we saw a lot of growth, and I think that does go partially to our privacy safe solutions, which are solving the problems that are faced by many of our competitors, or the customers of many of our competitors. So we are seeing people moving over to using us. And secondly, our platforms, with the combinations of like big data, fast processing power, artificial intelligence, in some cases patented components, are essentially delivering better results than some of the alternatives, which is attracting customers to us. Next question. With such a healthy balance sheet, couldn't more of today's acquisition been paid in cash, thus avoiding share dilution? Well, look, it's a controversial point. I would say the the thing that people criticize our company for the most, more than anything else, is our level of debt, and that's of net debt, and that's in a way surprising because we've got 4.5 times interest coverage in it through our cash. But nonetheless, we recognise that, particularly in the UK, it's a sensitivity among a lot of investors, and hence, if we spend all our cash, we dramatically drive our debt up to 2.5 times plus EBITDA, and clearly, whilst that may make economic sense, it would also put us out of favour with a group of investors. So rather than doing that, we went back to equity holders, and for those of you who are equity holders, we also have an open offer, so you can absolutely participate in this raise as well. And we were significantly oversubscribed, so there was clearly a great appetite from investors for us to do this deal and for them to be able to get more shares. Next question. I've been a shareholder for some while and impressed with your top line growth, but could you provide more information about your profitability? Thanks. So I know, did you want to talk about that, Michael? Or
Right. So we're as we try to convey, our profitability is impacted by IFRS rules, most importantly, probably on business combinations. But that gives us this item of amortization of intangible assets, and we're trying to give as many profit figures as possible to help readers of our financial information to navigate this. So our key metric is still the adjusted EBITDA, where we neutralized expenses which are not related to operating our business or the business that we currently own. This to basically give a clear view of the financial performance of the underlying businesses. But also from the pure GAAP metrics, you will see that despite this big amortization item, bit by bit, all our more and more P&L items become positive. So now we went into a quite notable profit situation for operating profit. We also had to break even on profit before tax, and as time comes, more and more of the profit metrics will come above the line. However, we believe that still cash is king, and therefore I think a very good metric would be our adjusted cash flow divided by revenue, which probably gives a relatively fair presentation of our profitability. And maybe still one word on accounting policies in general. In particular, our peers in the online marketing business quite frequently only report their net revenue as their revenue figure, and basically stripping out what they call traffic acquisition cost. And if we would do the same, we would actually then show our gross profit as revenue, $118.5 million, which with the $46.3 million EBITDA would give us a 39% EBITDA margin. And also that ratio has been very stable over the last few years. Also last year would have been pretty much the same. And when you look at it from that perspective, 39% EBITDA margin on the net revenue, plus in the growth rate, that puts us comfortably in that elite group of Rule of 40 companies.
Very good. Thanks, Michael. So, can you talk to us about the Fireball Search, .rua, and now VGL acquisitions? How much synergies do you think you'll be able to get? Are you able to give any guidance? Well, the Fireball Search and .rua acquisitions were very small, so I think together they had, was it $100,000 of EBITDA?
Yes, that is correct.
Yeah. So we're talking about, and so they have no staff, for instance. They're more assets, and but look, fireball search essentially means it's traffic, it's people using the internet, and as our online marketing business is a specialist in monetizing such traffic, it's a bit like if we bought one of the 100 websites that VGL publishers. It's a group of people trying to find particular things, and as we can match them with the right advertisers, or now we have a contract with big e-commerce companies with the right vendors, we're able, no doubt, to derive some revenue synergies there. Similarly, .ruhr as the domain extension for the Ruhr Valley, and all the cities there. Uh, it relies on infrastructure that was currently being provided by a competitor. We can do that ourselves, and so what was a external expense for the previous owners will be completely handled in-house for us. And so there'll definitely be some cost synergies, as well as bring our expertise in online sales. VGL, I think there's definitely a few synergies. One that I've mentioned is that we believe we can buy traffic cheaper than they can in some instances, so we can reduce their cost that way using our in-house resources. Similarly, we can let them use some of our infrastructure and infrastructure suppliers at our group costs, which will be able to save some money there. So it's early days. I'd say what this is, what the work that we have done at the moment would be best characterized as feasibility studies, which have shown us that we can indeed make these savings or obtain these revenue advantages. We haven't really moved to having full business plans for them, as the best way to do that is obviously to get the people that run these businesses to do the business plans, as they have much more detailed understanding. So look, it's definitely there. There'll be revenue and cost synergies moving forward, but I think it's too early stage to really indicate exactly how much they would represent. But clearly, the key thing is these deals are earnings accretive on completion. So it isn't like we have to wait to bring shareholder value. We already have done so. Next question. Can you explain what's happening with the pricing in your two divisions? Are you able to raise prices for inflation? Do customer contracts have inbuilt annual inflation-linked price increases? So I think the short answer is we can raise prices in some instances, and we do. So we often, not often, we probably once a year are doing detailed price reviews. But those price reviews have less to do with inflation and more to do with competition, and making sure that the overall result of increasing the prices is that we earn more money rather than we lose customers to competitors. So that is really our focus, and it's quite a painstaking project. Do customer contracts have inbuilt annual inflation-linked price increases? There are a few that do, but typically not. On the other hand, we do have clauses that would stop us ever getting caught in the middle. So if suppliers put their prices up, we can put our prices up too, as a general rule. Very good. Next question. Could you talk to us about cybersecurity in your operations, given the current geopolitical situation? Yes. So a number of our businesses we consider to be critical infrastructure, and so we have that type of approach with cybersecurity. There are some of our businesses that are only allowed to have zero downtime through the regulators, and so that involves an awful lot of redundancy in things like servers and data hosting and so on. And so that's really the approach we bring. We have just appointed a new chief security officer, and who's been auditing our systems. And as we have bought so many companies, clearly some of our businesses are stronger than others in cybersecurity, but it's definitely a focus and whilst the current geopolitical situation has maybe aggravated or drawn more attention to the risks, the reality is that that hackers and have been very active for many years, and they may include criminals, politically motivated, in fact, governmental level attacks do take place. And so happily, at least for us, we come very well prepared and experienced in repelling these kinds of attacks. Next question. I've joined late, so you may have discussed this earlier, but be interested to understand why the purchase multiple is so low and what the organic growth profile is of VGL. Well, look, happy to say VGL went looking for the right investor and the right partner in Germany. And as we have a very large presence in Germany, and clearly Michael being German and leading our M&A team, we were able to demonstrate to them that we were the right partner and that we shouldn't just be investing, we should actually be acquiring the business, obviously with this very attractive earnout and potential exit for the founders in 3 years' time. So we were able to avoid the issues of having a large international auction, and instead really were able to point to our experience of acquiring German companies and growing them really fast and being just a great home for growth, and happily they were persuaded, and now we're working together. In terms of organic growth, I mean, I think, Michael, our guidance is in line with the rest of our group, or in line with analysts' projections about the rest of our group.
Correct.
Very good. So thank you for doing an open offer for shareholders to subscribe to the fundraise and allowing them not to be diluted. In the future, please could you consider doing the same for your bonds? I'm sure retail investors would be willing to subscribe to these also. Very good suggestion. I don't know if as our bonds are issued in Norway, I think we're a little less educated about the how to open up bond offerings to retail, but I will absolutely do that and look into that. Next question. What levels of growth in EBITDA are required to earn the maximum earnout of 38 million euros? It's got to about triple. So it's very significant. Why was the placing priced at such a large discount? As a retail investor, I would have loved to buy my pro rata portion of the 45 million raise at 120p. How can I oversubscribe to the open offer? I don't know how you can oversubscribe to the open offer, but you can certainly buy your pro rata portion, is we believe, and difficult to say it was a large discount. I mean, there were multiple periods last week when the shares actually traded below 120p, so it's been a very, very volatile time, and we did feel like that we actually to be oversubscribed at that level, we felt was a very successful raise. Obviously, if the share price had been where it was on Friday night, continuously for months, we would have hoped for better. But considering it was below 120p at some points on both Tuesday and Thursday, it seemed like a fair offer to the board. Next question. Is the company affected by the current sanctions crisis, particularly for the Roo.com TLD? I mean, obviously, yes. The sanctions. Well, Roo.com TLD is actually an American-owned business. So it's whilst it's for Russia, it's an American-owned business, so that doesn't actually prevent us buying or selling those domain names. But clearly, there's sanctions preventing money transfers into Russia, and that we expect could affect our business moving forward. Happily, our exposure to Russia and the Ukraine represents a what roughly 1 to 1.5%.
Exactly, so slightly north of 1%.
And we don't expect all that business to disappear immediately by any means. But if it did, then it wouldn't really impact in any meaningful way on our business. Next question. Does CENTRALNIC also plan to present a number without traffic acquisition costs? Are you in talk with auditors to do so? An expected date? Thanks. Well, we've definitely been having the discussion with the auditors, but at the minute, the problem is that we run these two different divisions. And in one, I think the auditors are not at all sympathetic that we could do that. Based on various audit tests, they feel strongly that we need to be reporting on gross revenues or billings as gross revenues. Obviously, we're reporting. We're calling our net profit or our gross profit net revenue. In order to make that clear for those people that want to do comparisons with companies that report in that way, we're trying to be as helpful as possible. And look, it's possible as the business evolves and the mix changes that we would be able to move to that sometime in the future, but there isn't a date. Don't know. Did you want to elaborate on that at all, Michael?
Right. So first of all, we don't want to take the tremor route and then having different rules for different parts of our business, where some are reported gross, some are reported net. So it's more likely than not that we will just stick with the current presentation. However, if you look into our segment analysis, the gross profit that is shown there for the online marketing division equals the definition of the so-called ex-tech revenue that so many other online marketing businesses produce as their key metric, and therefore the figure is already in there and can be picked up by any investor who thinks it's the better metric for growth and volume of the business.
Thank you. So, Michael, the next question says the announcement did suggest oversubscription would be allowed to the extent others did not take it up. That's in the open offer.
Yes, that is correct. That is part of the terms and conditions of the open offer. However, the amount not taken up will only be known at the end of the process.
So it sounds like put in the biggest order you would like, and hopefully you'll get.
Everyone can currently only subscribe for 1 share for every 100.464 shares that they currently own. So you need at least 101 shares to participate. If any part is not uptaken, it's probably best to consult with your broker to run you through the exact process how to then participate in the allocation of any amounts not taken up.
That's great. Ben, Michael, I think I might just jump in there. I think you've taken every question that's come in from investors. I think Oliver's final one there, I think it's a statement rather than a question. I think that's that. So listen, thank you very much indeed for your time this afternoon, and indeed for giving investors the update on your news. I know investor feedback is important to you both, and I'll shortly redirect investors to provide you with their thoughts and expectations. But before doing so, if I may, Ben, just ask you for a few closing comments to conclude.
Very well. Well, look. First of all, thank you very much all for joining. It's very rewarding to get such engagement in particular. As you'll probably know, for the first few years when we listed, we were very focused on institutional investors, but we now see the benefits of having a much broader base of shareholders, and are very encouraged that the shareholders feel the same about us. It's been last year was a great year, a real turning point for us. I think something that we haven't mentioned is we did put out an RNS in mid-January indicating that the results were so good we had to forecast that we were going to be at the least at the top end of the analyst projections. We've already actually then been upgraded once this year. We have there's no changes that would lead us to change that in any way. So very happy to be able to share that with you all. And this acquisition, it brings myself and Michael, I guess, back to our days working in media. It is making us more of a media company, but the best kind of media company where you start with the revenues rather than starting with the content, and we're kind of backfilling the content into the business. We really see plenty of opportunities to build, just as we have in the online presence. We built a marketplace, so we bought a lot of companies with different suppliers and different customers, and then merged them into a marketplace where we could cross-sell between them. And now we're doing the same thing with online traffic. This is an acquisition with different customers. The e-commerce companies, different suppliers, of traffic, the websites that they own themselves. So again, we're building a marketplace where we can cross-sell, and this will make us a hugely robust business, and one where we're hoping we can continue along the path that we've already started. So with those thoughts, thank you again for participating, and looking forward to reading and acting on your feedback. Thank you.
That's great, Ben. Michael, thank you once again for updating investors this afternoon. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide feedback in order that the management team can better understand your views and expectations. This one will take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CentralNic Group PLC, we'd like to thank you for attending today's presentation. That concludes today's session, and good evening to you all.